Welcome to the Credit Clubhouse, where we take a weekly dive into the world of credit markets, alternative finance, and everything in between. Don't forget to follow the show, rate us, write a review, and share with friends. We're always open to guest or show ideas, so please feel free to reach out anytime. Just todd.anderson@dealcatalyst.io. I encourage you to check out the remainder of Deal Catalyst's 2026 calendar, including ABF 2026, Fund Finance West moving to Vegas for the first time, and GPLP Secondaries, which is a new addition to the schedule. Listeners can get up to 10% off any ticket to any conference by using the promo code CREDIT at checkout. And now, on to our next episode. This episode is brought to you by Cardo AI, the operating system for asset-based finance and private credit. These markets still run on spreadsheets and siloed systems. Cardo AI brings everything into one system: the data, the structuring, the borrowing bases and waterfalls, the cash flow modeling and simulations, and the investor reporting. That's front office to back office, all in one place. Today, more than 700 facilities and $150 billion run on Cardo AI. The world's most sophisticated investors and lenders use Cardo AI, equipping their teams with a level of control and intelligence that legacy tools simply cannot match. See it for yourself. Talk to the experts at cardoai.com. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Samir Tejpaul, Head of Investments at Madison Realty Capital. Samir, thank you very much for the time. Pleasure to meet you, and looking forward to our conversation.
Pleasure to meet you as well. Thanks for having me today.
Of course. So, you've spent most of your career across investment banking, capital markets, specialty finance, and ultimately now you're leading investments at Madison Realty Capital. How has the perspective on risk and opportunity evolved as you've gone from more of the arranging to now allocating investments?
It's a fair question to ask at the onset. I've been in the industry now just a little under 15 years, and in some ways there are tremendous similarities between where I started my career and where we are today, and the evolution of where I started in the banking sector and where I am now in the investing sector. The parallels I really draw upon in my career are, real estate is as much underwriting, investing, and due diligence as it is timing.
Hmm.
We can control the work we do on the front end, but whether you're in debt or equity, timing is a critical factor. And in some instances, timing works in your favor. In other instances, you find yourself in tougher spots. My general belief, though, is when you're in the debt portion of the capital stack, you have much more flexibility to withstand those difficult moments in timing. And something I really meditate a lot on is, I'm smart enough to give my client or my counterparty the loan, but I'm not always in touch with the market enough in the ways you'd want to be an equity investor. So I've gravitated in certain points in my career to doing both, but I generally find myself enjoying debt more. And I think debt really in the last few years, post-COVID, has really set the tone for the type of investing activity you see in the general commercial real estate sector.
We're obviously roughly at the half point of the year, a little bit past it. Are there any kind of common concerns that you're hearing either from the lender or investing, heading into second half of 2026? Obviously, there's been a lot of noise in various markets to start the year. There's obviously a war going on, but is there any common concerns that you're hearing?
I think we're in the same place we've been in the last 4 or 5 years, to be quite candid with you, Todd.
Okay.
We real estate and real estate finance really operates on a calendar cycle very similarly. So there's that first push when you come into the new year. I compete with and partner with various financing companies, banks, insurance companies, et cetera. And generally speaking, the optimism going into 22, 23, 24, 25, and now 26 has generally been the same, which is it's a new leaf, there's a new perspective, rates are going to come down, there's going to be more investment sale activity, and everybody's got a fresh allocation of capital, whether you're debt or equity. The irony is that first quarter typically has the biggest rush to the finish line. So what happens? Credit spreads compress, deal activity is robust. Whatever's carried over from the year prior gets closed. And then we find ourselves in this kind of Q2 moment, call it March, April into May. And there's some sort of, I wouldn't describe it necessarily as a catastrophic event, but there's some wrench that's thrown into the engine that kind of puts people back on their heels. So a couple things you could point to, obviously in 22, you had the rate hikes.
Yep.
23, we had a frozen marketplace, kind of peak SOFR being above 5%. 24, optimism about what was going to happen with the Fed. 25, we had tariffs going into Q2, which was certainly
Hmm.
came out of left field to the extent it was deployed or communicated. And then in
Yeah.
26, we find ourselves in a situation where it's kind of the confluence of a lot of events. Rates haven't come down as much as we had hoped. Obviously, there's a war going on, and there's wars going on. There are the knock-on effects of tariffs. There's clearly a lot of debt in the system at the sovereign level. You look at the United States, it's running a fairly heavy deficit. And I find myself in Q2 really saying we've almost experienced a full year already. So where do we find ourselves going forward? I look back at 25 for us in our investments team. We came in with a fairly good pipeline, but Q2 is really a defining moment for us. I think Q2 is really the defining moment for what we're going to be going into the second half of the year, which is we'll close the books on what we brought into the first half, and we'll look forward to the second half being one of enhanced scrutiny, right? The dust has settled in Q2. We know what's happened in the investment sales market. We know where capital is being deployed. We can be more selective. And we're our foot on the gas for the most part in all aspects of commercial real estate finance. We really gravitate towards value creation, but we can be more discerning. We've had a good start to the year. So where are we looking to deploy? We're looking to deploy in construction, adaptive reuse, assets that are coming off construction that don't necessarily have cash flow yet, where we can take a refined view on what's the business plan. Is it delivering 12 months from now, 6 weeks from now, or 3 or 4 years from now? So I think the second half of the year is all going to be about being more discerning, really understanding where supply and demand fundamentals are, what we've closed in the book, how our portfolio is, operating and managing itself, and where we think that the right places to allocate capital are. I think that's what prudent investment managers do, and we've been fortunate, and I've been fortunate in my career. That's kind of the approach I've taken.
Where do you think are the kind of the greatest divergence between market perception and fundamentals are today?
Holistically, I think folks have hoped for equity setting the tone, right? When equity dollars start to move into asset classes, folks generally think that's the tip of the spear as to transaction activity. I think it's quite the contrary. I think the debt market set the tone now and will be in perpetuity. Um, it's few and far between on those core or core plus or unlevered buyers in commercial real estate today. Those folks can kind of look past debt and the cost of capital it presents. And really, the vast majority of folks deploying capital in equity are looking for a fairly healthy return and they're looking for leverage. So, what do they look to? They look to the financing marketplaces, and the financing marketplaces are extraordinarily robust. So, on the upside, borrowing today on high quality real estate, I think is very dynamic. It's a very deep bench. And the deepest bench is in cash flowing assets that maybe need just a little bit more in the terms of seasoning to get into that perm loan or to get into that recap or to get into that sale. That's the deepest part of the market. But from my vantage point, that's where the least amount of value creation
Hmm.
happens. And the irony to your question is that it being the deepest part of the market, like in any industry, when you have a lot of buyers and sellers or borrowers and financiers, credit spreads generally the tightest there. So the asset
Yeah.
classes I can point to would be multifamily and industrial. Industrial has cooled off a bit. There's been an expansion in the asset class into, IOS, covered land, last mile logistics, in some instances, data centers, conversions of industrial. But generally speaking, I find myself looking at a ton of multifamily refis, and that risk reward in the context of most markets we spend time in, it's not one I think is that favorable to the lender because of that value creation. There's just not as much value creation. And it's less about the borrower, it's less about their business plan. I put a lot of faith in borrowers' ability to execute. But one of the things we all learn is you don't fight the Fed, right? So if you have negative leverage and rates are where they are and rates go up and you can't cover debt service, it's going to be very hard for cash flow creation to help you as a
Yeah.
borrower. It's going to be very hard for cash flow creation to predict a refi as a lender. And it's very hard in today's market to pin a cap rate on where you think something will trade in the open market. So I find myself being, and our team finds itself being very selective in the multifamily sector. In fact, we probably spend more time in construction and call it pre-certificate of occupancy financings because we think the additional runway is going to help in the next 12 to 18 months on the bridge side. Where I think that there's more value creation, where I think there's more opportunity is in construction. Generally speaking, that's where you're seeing most equity being deployed. It again, also as it starts and stops, everybody has their own yield on cost and what they expect to earn.
Yeah.
But if you look to the future with supply pipelines slowing down, with the hope of rates coming down, and you think of what could be really the growth story in some asset classes in various geographies across the country, I think that's a much more favorable backdrop. And in our business, that's generally speaking where you can get a little bit more spread or get a little bit more yield. So we're a value creation lender. We're looking for those opportunities. We're not a commoditized lender. We're not looking to be one of 20 lenders on a bid list. And I think our clients really value that perspective. And I think our team generally enjoys that value creation aspect.
I mean, you referenced geography. I'll ask, is there any particular markets that are more attractive today? And on the flip side, are there any markets that you're like, hey, this is maybe we should approach this with a bit more caution?
So where have I been a bit more bullish in my perspective? I've been lending and investing in the Bay Area for my entire career. The Bay Area continues to be an area where there is tremendous wealth creation. And when I say the Bay Area, you're talking about San Jose, San Francisco, East Bay, parts of Oakland, that surrounding area, going up into Napa and south into call it Central Coast. I'm very bullish on the Bay Area in light of what we're hearing about and the value creation and the wealth creation. I'm very bullish on housing in general in the Bay Area because, again, you think of San Francisco, it's a city of 500,000 or 600,000 people. There's not a lot of developable land. I really call it an island in and of itself. And housing always comes at a premium. And it's woefully underserved by housing in all directions. Now, I'm not going to go just yet into the differences in various types of housing that's being delivered, but 2 years ago when I started in Madison, I took the view that now is the time to go into San Francisco and shake hands with people and make relationships happen because that was, in my vantage point, the trough. And I look forward 2 years where we are today. San Francisco will likely be the best performing residential rental market in the country for the various reasons I just described. No new supply has been delivered. It's a small geographical area. There's a tremendous amount of wealth and value creation. And I think that we haven't missed it, but that train is moving. And it's not just housing. We just closed two financings in the Bay Area on the hospitality side, one in Palo Alto, one in Santa Cruz, in markets where in Santa Cruz, for example, there hasn't been call it a 4 to 5 star luxury hotel delivered right there on the coastline in 40 years. Talking about a one of one opportunity. And that really came by getting to know a client, the same client who had an asset in Palo Alto, right there between Snowflake, Meta, just north of Stanford's campus, where you haven't had a new hotel delivered in 15 years, right? So if you take a view and you really understand supply and demand fundamentals, you start to understand what's happening with the local economy and demographics. There's opportunities in every asset class. Now, the Bay Area, as it has done historically, will, I wouldn't say overheat, but it reaches its peak. And then you really need to start to reevaluate. But I do think they're on the upswing. Other markets I'm really excited about. I think for all of the noise in the channel, the tri-state continues to be a great opportunity. There's still a lot of value creation in all asset classes in the tri-state. We closed a very large loan last year on a 2 million square feet, up to 3 million square foot industrial campus in central New Jersey. Central New Jersey and the tri-state has the deepest industrial market and the deepest demand drivers in the entire country. You've got the port, you've got the airports. You kind of look through the noise in the channel in Q2 with the tariffs, and you say to yourself, how much new construction is being delivered? What sort of incentives are developers being provided? What do the tenants want? And then you make an educated investment decision. Again, I was smart enough to make the loan. I wasn't necessarily smart enough to understand the equity play, but that's the benefit of the relationship I have with our borrowers and clients, and our team does. Um, Maybe I'll go to some markets where I'm a little bit less bullish.
Yeah.
I'm generally, and our firm historically has been a bit more risk off in office. And I think that is genuinely everywhere across the country. That's not to say we won't lend on office.
Has the office dynamic kind of, I guess,
It's totally bifurcated.
settled?
It's
Has it
totally
settled
bifurcated.
post-COVID?
I look at cities like Dallas, I look at cities like Charlotte, in DC, San Francisco, Chicago, New York City, Boston, Miami. I wouldn't call it trophy. I would call it just class A. Everything above class A up is a really terrific bid from the demand drivers, which are financial, AI, um, corporate, marketing, VC tech. I think you're seeing 15 to 20% rental increases in class A plus office across the country. Because again, 3 or 4 years ago, folks stopped lending into that
Yeah.
thesis. And what it's created is a limited amount of class A supply and a tremendous amount of demand for it. But that's the haves. The have-nots are the class B and class C office space. Some of the class B will catch a bid because, again, if the class A tenants can't get what they want and they need to shift down and either move to new space or expand, they will have to take class B in great locations. But everything below that still is very much struggling. And we're seeing much more of that buy the office, demolish it, or buy the office and convert it to hotel, condo, office, student housing. We're seeing that implemented across the country with a lot of incentives by local municipalities because those local municipalities need to raise tax revenue. So office is a very bifurcated market. Generally speaking, class A plus, I think, does very, very well. But for everything else, it has to be reconstituted, or you have to have a very long dated business plan.
You know, if we think about private credit, which is obviously something that, we've covered a lot here on this podcast, and obviously private credit is very much diversified today away from the traditional direct lending, which is what it was originally called. But how have you seen the impact of private capital coming into your space, and have you seen, I don't know, I've called them tourist investors in the past, but those that might come into the space who might, not be as value creating as you say, and just are more competing on spread. And has that, materially changed any dynamics for what you guys do?
So I'll rewind the tape. Private capital, alternative lenders have existed for inception of commercial real estate finance. You can call it hard money lending, you can call them mortgage REITs, you can call them private closed-ended funds. Pre-GFC, call it 2000 to 2008, generally those folks were making equity investments.
Yeah.
They were taking that last 80 to 90% of cost, call it sliver, and they were earning very healthy returns, but they were taking equity risk. The banks pre-GFC were willing to go north of 80% in some instances to make a deal happen. And a lot of that underwriting was all pro forma based. And it doesn't matter if it was CMBS or if it was balance sheet, whether it was construction, bridge, or perm. I think what the GFC showed us is that value degradation can happen extraordinarily fast. Those folks who were invested as alternative lenders or stretch lenders pre-GFC generally caught the falling knife. They quickly became equity and then they quickly became, insolvent and or got wiped. And then whomever was the senior lender in those capital structures had to pick up pieces. And then you had this transition post GFC where obviously real estate performed fairly well from 2010 to 2015. Most of the activity was in the fixed rate side. Once folks had cleaned up that senior portion of the capital stack, wiped clean the equity and the alternative lenders, most of the activity was borrowing fixed rate. So CMBS was, when I started my career, CMBS was most favored nations, and it was certainly the go-to lender for folks that carried their assets through the GFC. You didn't see as much alternative lending, value creation lending, private capital, but I think 14, 15, 16, as that wave of perm financing sort of subsided, we got back into the world of value creation. But the difference being in that period of time was banks weren't at 80% and you weren't having to top up that 80% of cost or value to get to 90 or 95% to make a deal work for the borrower. Banks were 55 to 60% of cost. And I genuinely think banks are generally 55 to 60% of cost. Rates move up and down. They might move up 5 or 10 percentage points. But generally speaking, banks, the lowest cost of capital, want to be in that 55 to 60% of cost range. So alternative lenders had a much better opportunity. They could then run from 55 to 75 rather than from 80 to 90. And the sorts of yields you were earning, while they weren't equity from 15 to 20, 2015 to 2020, they were still fairly healthy. I mean, you could make high single digits, low double digit returns on what I think was very safe real estate. And I think the equity market and the equity mentality started to take notice of it. And then capital pools started to develop that wanted to be invested into private credit, alternative lending, and take advantage of the opportunity, primarily from folks in the equity side that couldn't buy the asset but wanted to participate. So you have the biggest names in the industry, Starwood, Blackstone, Brookfield, et cetera, that created debt arms to their investment shops. And the mortgage REITs took advantage of that as well, raising money from the public markets. And as we got later into 18, 19, 20, things started to maybe taper off. In other ways, some folks started to spend more time in construction. But generally, banks were 55 to 60%. So the opportunity set was fairly strong. Where we are today, in a marketplace where equity is few and far between, and the maturity of the alternative lending market has just continued to grow, is almost every alternative investment platform has a private credit fund, a mortgage REIT, public or private. They have some sort of specialty asset finance or asset-based finance platform. And I think from my vantage point, the reason being is capital likes being lower in the priority scale, not equity, but not the senior. They want to make equity-like returns. They'll give up some multiple to do it, and they want to stay invested. And I think every industry is experiencing the same sort of thesis. So where do we go from here? Cost of capital for the alternative market continues to optimize. Folks are going to earn less yield as the marketplace matures, as equity finds its footing. We now bump into banks more than ever in the last 5 years because banks, as they always have been, want to be asset-based lenders. There's no better collateral than real estate secured,
Yeah.
and they need to deploy capital to make money. So it's really that we're in this moment now where alternative lenders want to innovate without taking as much risk as they did pre-GFC, but they also want to earn more than banks. So we're in this really interesting dynamic market in the debt space where, there's a lot of activity. There's a lot of competition.
Is that healthier than pre-GFC, would you say?
I think it's healthier. I think competition is very healthy. I think we want to see best-in-class real estate succeed. We need new supply in every asset class. we're not meeting demand for new high quality assets. For the most part, there are some assets that are oversupplied that are newly delivered. But the differentiator in investment managers is going to be investment thesis, asset management, supply and demand fundamentals, and really investing into the best borrowers, but also being innovative and creative. You don't have to be boring to be in debt. We find creative solutions for our clients all the time. I think that's why our clients love working with us. I think that's why our brand grows. And we walk a fine line between sticking to our thesis, sticking to who we are, but also trying to either take market share or innovate. I think that's the key, right? Because with more competition, if I do the same thing, my team does the same thing, our thought leadership does the same thing and has the same mentality as we had last year, the year before, we won't be as successful because our competition around us is also trying to gain market share and trying to innovate.
Your comment around, banks are 55 to 60, I think roughly was where you say, do you think as private capital continues to grow, does that number come down where banks are even less than that, or you think they've kind of fallen into kind of where they should be?
Generally speaking, banks and insurance companies are metric-based lenders, right? So debt service coverage ratio, debt yield, LTV, LTC.
Yeah.
So there will always be a marketplace where private capital, alternative lenders will participate. In light of where we are with rates, and rates change every day, every quarter, every 6 months, every year, I just don't see banks getting more bullish and stretching on cost or value in the near term. And I think that, again, the majority of the marketplace, absent CMBS, is dominated by alternative lenders and will continue to be dominated by alternative lenders. If we saw a meaningful drop in base rates and all in, so call it coupons, I think most private capital will get refinanced out. So we'll get capital back. We'll be financed by more cost effective or lower yielding cost of capital. And then we will have to redeploy. And then we'll have to be really thoughtful about, although rates have come down and there's more margin, what is the supply and demand fundamental? Banks are generally, though, constrained right now based on what's happening in the rates market. That's
And
really the
didn't
governor of their LTC or LTV.
and didn't the ECB raise rates
Yeah,
today?
they did since first time since 23.
Is that going to
Um,
change any dynamic, or you think that's,
European financing markets are much different than the US markets. It's
yeah.
much more fragmented, and that although you have the EU, you have different jurisdictions and protocols and insight and data. Um, I think we're just in a holding pattern for the time being, based off the new Fed chair, the presidency, inflation. We're just not, again, to the point I said earlier, we're not looking to do razor thin margin business. That's a different segment of the market that I think has its own, call it, competition. We continue to be that sort of value creation, thoughtful, nimble sort of investor. And the backdrop for us is still very good. Our pipeline is very robust. We'll do in the next 10 days or so about $1 billion to $1.5 billion of closings. Those loans could be as small as 50 million. Those loans could be as large as 480 million. And it's a wide swath of geographies, asset classes, business plans. I think for me, that I get up every day and I'm excited to go to work because no one deal is the same. And I think
Yeah.
it's a great opportunity for junior talent. And even, somewhere I am in my career, learning a lot. I learn a lot every day and I continue to want to learn. But that's what makes us better investors, is because we see so much. We do a lot of different things. We know what we want to do and we know what we don't want to do.
You referenced data centers before, but I think if we look at, kind of AI, commercial real estate, obviously AI is creating enormous demand and, the need for data centers. And I'm always confused, like, is it a real estate place, data centers? Like, what are data centers? It feels like they kind of straddle this line of, what they can and cannot be.
I think the similarities are it's tangible. It's something you can touch, feel, and see. It's got, in some ways similar characteristics of developing an industrial campus or an individual large-scale industrial asset, but the fundamentals of it are way beyond commercial real estate. It truly is one of energy, infrastructure, transport. Um, it's extraordinarily dynamic in that it doesn't have a lot of historical data in many of these markets where people are allocating capital. Data
Yeah.
is critical, right? So we don't know what the performance history of building a data center in Louisiana or Ohio or Atlanta will be dating back 20, 30, 40 years ago. Folks are allocating capital to those markets because there's energy availability, not necessarily because it's a tried and true investment market,
Yeah.
which is absolutely fine. But for us, we really supply and demand fundamentals are critical in every asset class we invest into. I think supply and demand fundamentals in infrastructure are much more gray. I think there's so much more on the whiteboard that needs to be filled in. And it is a heavy operational asset. And it's an operational asset you have to build out and scale. Development, operations, security, sales, marketing. The end users, while they're the same corporate credits that lease industrial and office space, the uses of it are much different, much different. The check sizes are much different.
Yeah. I mean, how do you think about, the adoption of, say, move away from data centers, the adoption of AI with your business and even, the dynamic of potentially the changing workforce and what that could mean for office and the growth of AI and what that might mean for how companies are thinking about office?
So I'll touch on office first. Every marketplace in the country is seeing leasing demand in the office sector from AI tenants. The vast majority of those AI tenants, call it 50%, not the vast majority, 50% are tried and true corporates that have been office leasing intermediaries or consumers for a long, long, long time. Microsoft, Google, Meta.
Yeah.
Um, and then you have this huge swath of new names, the OpenAIs and the Anthropics. Office in the Class A sector is a winner with AI. I don't think headcount comes down in Class A office based on what I'm seeing in the AI space. Is it a negative for Class B and C? 1000%. So that bifurcated office thesis,
Yeah.
I think, will continue to diverge. It's right in front of our face, optimization and utilization. If you can use 50,000 square feet or you're otherwise using 200,000 square feet, that's what AI is supposed to do. It's supposed to communicate to senior management, we don't need this amount of space. We can optimize it and be more cost effective. So office is a winner for Class A upwards for new supply in the next 5 to 10 year horizon. It's a loser with AI in the Class B below. Other asset classes I think that are favorably impacted by AI in the interim, I think industrial. I think industrial has a lot of optimization that will come from AI. We're doing a deal right now in Texas, in South Dallas, where supply is extremely constrained for two reasons. There hasn't been as much industrial delivered because there was a big push after COVID um, to develop to meet consumer and distribution demand, logistics demand. You also have the fact that a lot of that developable land is now being converted to data centers. So that's a competition in a supply constrained market that's only exacerbating what's happening in the industrial leasing market. So you're going to see industrial leases go up, cost of renting go up, but also what happens within the property is going to change a lot. So that investment we're making in Dallas is one of an AI logistics company that's backed by some of the biggest names in the world that will be not fully automating, but as close to fully automating the way that they move goods in and out of their ecosystem. And I think you're going to see that same thesis play out in many, many large scale industrial properties, whether they're older or newer. I think it's very exciting for industrial in particular to adopt the efficiency and utilization that AI can bring them. We're a little bit further away from robotics, which will change the human aspect of who operates these facilities. So I'm not going to
Yeah.
comment on that. Where I think there's some headway with AI and other asset classes I think housing in general is going to get impacted by AI. I have this conversation a lot. If you don't have to commute half an hour to an hour to work because your office space is smaller and it's further outside the city center, you're going to not pay the premium to live in that in-town location. You're going to have more space. You're going to have the ability to have a larger family, to live, at a more cost-effective manner with what you're paying for rent or your mortgage. So that might mean that people live further away from city centers. Um, Autonomous driving. Folks can commute to work and be as productive in the car that's driving them there, in a share car or an individual car. They're going to start commuting to work at different hours of the day. They're going to start leaving work at different hours of the day. We're not going to need as much we're not going to have as much congestion in the system for that commute. Does that make it better for cities and city infrastructure? In the near term, I think we got to figure it out.
Yeah.
Um, there might be some pain in the interim, but long term, I think it's better. But fundamentally speaking, with housing, rental housing in particular, as I said, rental housing has a lot of supply in most markets. Most of these southeastern and southwestern markets have seen their supply pipelines double or triple. And when you have a doubling or tripling of supply, that demand for it's got to come from somewhere. Is that
Yeah.
job creation happening at the same clip as it once was post-COVID? I'm not sure. And that's why I think multifamily probably gets impacted to more so than folks imagine. Because that young professional or that, young couple or that couple with one kid, they're going to look to optimize their life as well. And they're not going to want to pay perhaps that premium that it means to live in town or buy that house that's 20 or 30% above what they can afford today. They might live further away. So that's really interesting for me. I think about that a lot. That has a lot of touch points. But that's my general opinion of AI overall in commercial real estate. How it affects our business day in and day out. I'm more than happy to talk about it if you'd like me to continue.
Yeah, I'm curious in terms of, what it means for underwriting and, a bit more of an impact on kind of what you guys do day to day.
So for us, there is no substitute for seeing the real estate and the trade area. I like to take our team on the road a couple times a year at minimum. And when we do, we'll do 50 plus deals this year. We need to go see every asset. We need to see every comp. We need to understand how people are commuting to or from um, the assets we're financing.
AI
And
doesn't replace that.
no, AI was not, that's my punchline. AI is
Yeah.
not going to replace the physical aspect of real estate. AI is not going to replace picking up the phone and making that final push with a client. It might give you the reminder, the check-in, et
Yeah.
cetera, et cetera. But it's not going to push me or the client to say, I want to work with Samir, I want to work with Madison Realty Capital, right? That's the human aspect. That's the personality. That's the relationship. AI will enhance that, my ability to like cut through things faster, or team to cut through faster, but that's not going to be replaced by AI. Decision making at the end of the day is in the hands of the key stakeholders of every institution. I think AI is going to supplement the data that they take in and review, but ultimately it's a judgment call. There's not enough data to analyze what those senior decision makers' judgment calls are till 2, 3, 4, 5 years in the future.
Yeah.
Day in and day out for our analysts, associates, VPs, directors, I think their ability to sort, analyze, implement the data we can from every asset class dating back 20, 30, 40 years, it's going to be instantaneous. We're going to take a view on how much new supply is coming online, what's the absorption been, what are the concessions, where are the demographic trends. Those sorts of analytics that get done in 2 to 4 days, they're going to get done simultaneous, instantaneous within a few hours or overnight. We're going to be able to load everything up overnight and then wake up in the morning and we're going to say we have 100 deals in front of us. We want to really spend time on 15. I think AI is going to be able to get us down to the call it 6 to 8 we really need to spend time on that have the fundamentals we look for. That's happening real time. I mean, we're running a lot of our processes through AI now. And I think in the next 6 months, we want to be at the tip of the spear about how we are implementing AI, not just for the mundane tasks, but really the thought-provoking ones.
So, if we look ahead, and we have a few minutes on, less fun or more serious questions, then we have some fun questions. But as you look towards 2027, is there a particular market outcome you think investors are least prepared for?
I think that the equity markets are going to have to capitulate in that they're going to have to sell at numbers they otherwise have been holding out for, lower numbers than they've been holding out for. I think everybody has aspirations of cap rates being at X, but they're going to have to trade at Y. The reason being is we're getting further and further away from the rate hikes. We're getting further and further away from them having that big coffer of liquidity. And I think they're getting closer and closer to where folks are really willing to buy and invest on the equity side. I had been hoping for that to happen much sooner than it did now because I do think equity, generally speaking, whether it's building, buying, or recapping, is a good thing. You want fresh perspective. Um, but I'm hopeful 27 will be about that much more so than it has been. But now we've had some starts and stops. In the debt space, I think that we are going to be, relatively speaking, in a similar sort of rate environment. And I think that the prudent investment managers are going to take a payoff or take a refi where they should rather than stay in a loan or an investment for the life of it. And the prudent managers are going to prune their portfolios and really focus on maintaining the right amount of liquidity going into 27. I, you know, take the GFC as an example, right? 8, 9, 10, frozen.
Yeah.
11, 12, 13, you have this sort of slow build back up. And then 14, 15, 16, really the marketplace is wide open. If we look at 22, 23, 24, it's frozen. 25, 26, 27, we have this slow, perpetual kind of hopefully upswing. And then I think 27 beyond, you're hopeful that with all the capital that's been brought into the ecosystem of debt and equity, it's a much more robust buyer and seller marketplace. And with that, I think debt will continue to set the tone because I think debt will innovate and continue to just optimize those decision-making, um, decisions. We weren't that far away, to be quite candid with you, Todd. I think
Yeah.
coming into this year, people were borrowing in that 5 to 6% sort of context. A couple people were borrowing inside of 5%. You can make really sound business decisions in a sub 5% coupon context. We don't need to be at a 4% to make the market work. We didn't need that pre-GFC. We didn't need that in the 2010s. We don't need that now, but we need stability and we just need a little bit more compression. But I don't control the Fed. You don't control the Fed. We don't control the global economy. It seems
Nope.
folks want to get paid more now than ever, whether they're equity or debt. And, we really just got to be thoughtful. Liquidity is important.
Yeah. So, a few fun questions as we wrap up here. Favorite sports team and/or hobby?
I'm like physical fitness. I like the challenge, whether it's, me versus me or a group of us versus one another. I think it's good to stay sharp, whether it's your friends, your significant others, or your team. I'm someone who wants to be as sharp physically as I am mentally. In terms of sports, there's no better team sport than football, in my opinion. I learned so
Agreed.
much during my football career, types of men I interacted with, whether they were my mentors or my teammates. It really teaches you about how every individual person has to just execute their job, you know? And you have to work together and you have to communicate. Life is all about communication. Our industry is all about communication. Being a great teammate's about communication. So my favorite football teams would be the San Francisco 49ers and the University of Miami, the Miami Hurricanes. The Niners, in some ways, I inherited it, that legacy and those just amazing, teams that we had with all those Super Bowls. I was born in the Bay Area. And then as someone who, I'm a child of folks who immigrated here in the 80s and have been the American dream and worked really hard for everything they've gotten and given back to their community. When I started playing football when I was about 10 years old in 2000, There was not a more exciting team to watch and root for than the University of Miami. They had that brash
True.
sort of mentality that like we don't, we're not gonna bend the knee to anybody, and they're gonna beat you and they're gonna let you know. But they also have that legacy and that fire and that desire to win. I think both teams do. I want to win. If we're going to be on the playing field, we're playing to win. I don't care if it's the Dallas Cowboys or the Florida State Seminoles. We're there to win. We're there to win the biggest games and the biggest deals, and we like to compete. So football taught me a lot about being a great teammate and being a competitor.
One surprising thing about yourself.
I really like being alone from time to time. I like going for walks. I like being with my thoughts. I like challenging myself, being introspective. We all have just so much room to improve. And it's, the quietest moments for me are typically first thing in the morning. I would generally say I do my best work first thing in the morning. I tell a lot of people, we can make almost all of our best decisions between 6 and 9 a.m. And if we make those decisions, typically the hardest decisions, then we really set up our day and our week for success. So I really
Interesting.
value that quiet time in those mornings.
One book that you'd recommend reading.
I don't consume a lot of literature in that way. I'm constantly reading other things, right? So I'm always looking for, call it the edge, call it the insight. So I'm the guy that will stay up till 10:30 or 11 and read the Green Street report about what's happening in Nashville or what's happening in the investment sales sector for hospitality or every article I see on Bloomberg that's thought-provoking or The Economist or the FT.
Yeah,
I'm constantly reading, but I don't have as much time to sit down and read a book just because my day can be fairly hectic and I
I can
really do love
understand
what I
that.
do. The most recent book I read though was I think it was The Rise of the Flower Moon. I think it was about the Comanche in Texas.
Hmm.
It was really thought-provoking. I would say the Comanche, this is such a wild tangent. The way they were able to master the horse to cover large swaths of land was their technology that they optimized. And for that, they were, the most dominant sort of human beings on the plains for 100 years. And they just innovated that, whereas other tribes didn't embrace it.
Yeah.
So that's a really interesting book.
Most exciting part of your job.
The human aspect is the most exciting. The mentorship that I receive, the mentorship I give, the opportunity to put somebody on in their career, to see them grow. I like to say that I sit in a room and I don't want to say anything. I'd rather just have my team talk the whole time. And where I feel like I need to interject or insert myself, I will. But I think it's a sign of a really good leader. I had someone in my career tell me there's two types of leaders in this world. There's leaders that push everybody down so they could elevate themselves. And then there's leaders in this world that elevate everybody around them so that they can enjoy in the team's success and their own success. I've always gravitated and subscribed to that second type of leader. And we have an amazing team. We have great leadership in the founders of our business. We have a very flat organization. Everybody can speak their mind. And the best idea should win. Truly, the best idea should win. So if I can put them in a position where their idea can win, I would love to do that. I strive for that.
Back to your example of football. Yeah, sounds very much a correlation there. And then one final question for you sitting here a year from now, one prediction.
I think the stock market will be up. I think we will be in a better growth environment as a country. I think that we will have hopefully navigated the eye of the storm that we're in now. And I always will bet on America. I think that there's no place better to deploy and invest capital. And we have the hardest working people in our country. And hopefully, a lot of these innovations we talk about will help us continue to succeed. So I'm rooting for the US and our partners. And I think 27 will be in a better growth environment. Hopefully, a cheaper cost of living and a lower inflation environment too.
Well, that's a good place to end it, Samir. Thank you very much for your time. Really appreciate you coming on the show and continued success, to you and the team.
Thank you very much, Todd.
Thank you. Thank you for listening to the Credit Clubhouse podcast. Credit Clubhouse is brought to you by Deal Catalyst. the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.